Ratio analysis is a technique that requires excellent calculation skills. But that's not it. Above all, it asks for interpretation and the ability to bridge the gap between individual indicators. Let's say you see that the net profit margin goes up. How would you decide whether this is so because of a revenue increase or lower expenses? You wouldn't be able to before you decompose a ratio to its ingredients and analyze their performance separately. In this lesson, we will find out how to do that by utilizing a widely used technique called DuPont Analysis. The methodology has earned its name from the DuPont Corporation. The company was one of the market leaders in the chemical industry when, in the early 1920s, Donaldson Brown, an expert in the Treasury Department, came up with a revolutionary, powerful tool for financial analysis. Indeed, Brown has left behind a fascinating gift to all the practitioners to come. At present, investors and financial analysts from around the world still use it widely. In its core, this is a fundamental framework for performance assessment, which considers various factors influencing investors' returns. That's why its starting point is the return on equity measure, the ratio between the net income of a firm and the equity capital it utilizes to achieve these profits. Ready to dive straight in? All right. The traditional approach breaks down the return on equity formula into its constituent parts. Here is how it works. Return on equity equals net income divided by average equity, right? Now, what happens if you multiply both the numerator and denominator by total revenue? Then we have two formulas. One times the other still gives us return on equity. Hold on a minute. Do you recognize what these two ratios stand for? Spot on. Net income over revenue is the net profit margin of a company. How about revenue over average equity? Well, we do have revenue in the numerator, so it must be a type of turnover ratio. That's right. This is the equity turnover indicator. Having clarified this, we can confidently say that ROE equals the net profit margin multiplied by equity turnover. Terrific. Let us perform the same task once again, but this time you multiply both the numerator and denominator in the equity turnover ratio by average total assets instead. What's the result? Revenue divided by average total assets is the asset turnover ratio, and average assets over average equity is the financial leverage ratio, right? Clever. In short, this is how we get to the traditional three-way DuPont model. Return on equity equals net profit margin times the asset turnover times the financial leverage of a firm. Return on equity is higher when a company renders a better operating efficiency, better asset management efficiency, or employs higher debt. This is arguably one of the most important formulas in the world of financial analysis. The brackets under the formula demonstrate how all the ratios are calculated. The breakdown into three distinct components makes it possible to establish which of the three has the biggest impact on changes in the return on equity. The ultimate goal is to determine what causes the measure to fluctuate so that the management knows which problems to address. If the ROE of a company goes up, this might be a result of increasing net profit margin or improving asset turnover. Alternatively, it might be the case that the firm increases its debt capital, which needs to be tackled with caution. Why? Because higher leverage is always associated with higher risk. Either way, we can't say for a fact without getting down to the basics. Performing in-depth DuPont analysis allows you to tell the reasons for potential changes in returns. So far, so good. We will now move on to another way of calculating return on equity. How exciting! Stemming from the three-way model, DuPont analysis can be further extended by decomposing the net profit margin component. As you know, the net income of a company is calculated after interest and tax expenses. So, if analysts want to see the underlying reasons for a net profit margin change, they should turn to its constituent parts. And so, we go ahead and exclude the interest and tax effects by calculating the operating profit margin, interest burden, and tax burden separately. It's like a timepiece. Even though its components appear to be remarkably complex, Every part has its purpose. When it no longer shows the time correctly, the watchmaker will then disassemble the watch to check on the matter. Like a real financial horologist, you can easily calculate these sub-ratios if you have an income statement in front of you. By definition, the tax burden is the amount of net income, this is the one after tax, divided by profits before tax. This expresses the effective taxes on profitability. Similarly, the interest burden is the amount of profit before tax relative to profit before interest and tax. Okay. Why do you think companies strive for higher interest and tax burden ratios? We'll explain now. Take the border case when there is no interest and tax expense. On that occasion, the operating profit of a company will be the same as the profit before tax and the net income. Therefore, the interest and tax burden ratios will then be equal to 1. Okay, any increase in the interest or tax expense would cause these ratios to fall below 1. So, in essence, the lower these two ratios, the higher the tax and interest effects. No wonder firms want to keep the interest and tax burden ratios as high as possible. All right, back to the formula. If you multiply the 3 indicators, you will still get to the net profit margin. In turn, net profit margin times the asset turnover times financial leverage equals return on equity. Piece of cake, isn't it? Okay, and this is how the 5-way DuPont analysis looks like. Make sure you learn the ropes of this equation. Fantastic. From a practical perspective, we may use it as a departure point for a company's strengths and weaknesses outline. Each financial ratio in the model can be further analyzed to get more insight into the underlying reason for a change in the return on equity measure. Executives can then take improvement measures in terms of cost control, asset management, or debt burden. The bottom line is to find the weak link and find a way to improve returns. Once you step on the investment field, you need to be careful when an organization's return on equity turns out to be negative. Investors normally stay away from firms that have reported a less than 0 ROE because they perceive it as a warning sign of excessive debts or significant operating losses. All right. Does the DuPont model have some limitations, you might ask? Of course it does. Quality-wise, the output of every financial model is as good as the inputs we use. This goes to say that the data used to calculate the ROE might be prone to manipulation. Assets might be overstated or net income understated as a result of different accounting policies and management estimates. Thus, to ensure that the outcomes of the model are correct, you should use reliable and accurate accounting data only. Another disadvantage that is inherent to all financial ratio analysis methods is that we could only compare companies of the same size, industry, and capital structure. Always compare apples to apples, remember? And last, any analysis is highly susceptible to seasonality trends. Weak indicators may be only temporary if they are due to low sales volume during normally slow seasons. That's why you should be thorough and track how the DuPont ratios evolve over longer periods of time. Amazing!